You're listening to the Reinvest Podcast, where each Tuesday we show business owners and entrepreneurs how to reclaim, reconnect, and refocus their life by bringing you the top real estate professionals in the industry. We'll help you diversify into real estate by equipping you with the tools and tactics to build generational wealth. Your hosts, Garrett Gatton and Seth Simonillo. Man, it's a good day in the studio. We're excited to jump in today's episode. So here's the question. What if you could invest with the wisdom and the confidence that only comes from putting over $1 million into all types of real estate deals, but never have to actually put the money in to get the wisdom?
And you can today for only 4 payments of $19.99. So if you send us that, we will get you that information, and we're off to a great start.
Man, there is something really unique and beneficial. My wife's really good at this, about learning from other people's successes and from their failures. And that's the beautiful part about the podcast arena, information, kind of the digital age, so to speak, is you can get knowledge that didn't come from your experience and learn from that, make it actionable. It doesn't eliminate having to go through the failure yourself in some areas.
Well, you have to make it actionable.
That's the key.
If you listen to this podcast or any podcast or read any book and you don't actually change something or implement something in your life, you essentially wasted that time. So just kind of keep that in mind as you are growing and learning and developing as a professional and in real estate.
Got to take action. And today with us to impart this wisdom is Spencer Hilligoss. How are you doing, Spencer?
Doing great. This is a wonderful way to start the day. Thanks so much for having me on, Seth and Garrett. This is awesome.
Man, we're excited. So first of all, tell us where you're located in the country and tell us about Madison Investing.
Yeah. So I'm based out in the Bay Area, California. Originally born and raised here. Spent a good decade living in Colorado and came back to the Bay Area. It's where I grew up, but also spent the lion's share of my W-2 career, which I did tech companies. It's kind of a thing a lot of people do out here. So that's where I'm based right now.
So how did you like Colorado?
Oh, don't get me going. It's like
a buddy of mine, he moved out there and he would like ping me every 3 months. He was like, hey, when you coming out here? When are you going to move out here? And I visited once for a real estate conference a couple years back, and it was everything that it lived up to.
It's a special place in my heart and our heart for Jennifer, my wife, and I. We met at college in Boulder. We lived there for a decade between Denver, Boulder. I love it there. We've considered moving back a number of times, but we got roots here. Kids are in school. We're happy here. Even though we have California, I know the real estate community loves to dog on California if they're not in California. Very well deserved for all those reasons. But we're sticking around here for a good run.
I feel like if you can do real estate in California, you can do real estate anywhere. Like,
man,
just with
So what were you doing with the tech companies? Any tech companies that we would know of?
Yeah, I mean, a few probably. So quick, just kind of background on me is, these days I lead Madison Investing, which is a passive investor club. But now the lifestyle has allowed me to step away from that tech career. That tech career, though, special place in my heart. I was there for 13 years, 5 financial tech companies. The cool way to say that, fintech companies. Never in my life thought I was going to be going in to do anything related to really business management, tech companies in general. I was a kid that played in punk rock and metal bands and thought that business was really boring.
Was your hair longer then?
It was.
Nice.
There was a lip ring. There was still a lot of tattoos, but
there it is.
I think going into full disclosure, my dad was a broker for 30 years, right? My dad was a real estate broker, residential for 30 years. So I was doing open houses for him in early teenage years. I was cleaning out fridges for properties. Like, it was why I went to tech.
Those were before child labor laws. Yeah.
Yeah. I mean, we'll leave that one there, but in terms of companies I was at tech-wise, started at big company experience. It was with Intuit. People know them because they do third countries taxes, tax filings, TurboTax, et cetera. And then I went to a string of competitors for that, so Gusto, Zero with an X for the nerds out there who like the back office payroll stuff, which not many people do. But the 5th tech company I ended up at was Lending Home. Now it's Kiavi, biggest fix and flip lender in the country, I think now.
Yeah, actually, I think I've seen them come across before. Yeah, that's interesting. So how did you get into the real estate investing? Like, when did that come onto your radar to come in as a passive investor or get to the point where you started a club for passive investors?
Yeah, anything entrepreneurship related, it's clear as mud when you start. Yeah, and I know
Right. That's the truth.
like you guys know that. It's so Jennifer, my wife and co-founder and COO of our business, we both were working full time in the Bay Area. This is back in around 2016-ish, grinding, making great W-2 income, dual income in the Bay Area that's necessary for most people, growing family, just crushing on the W-2 income, maxing out 401ks, feeling great about that, patting ourselves on the back for that, of course. But then just hitting the point where it was like, well, this is no on-ramp. I mean, no off-ramp rather, right? There's no, there's no freedom coming anytime soon. I hadn't seen like at one point with my younger son in like 2 weeks because I was going in early, coming home late, etc. And when I got to a point of a mentor guiding me into lending home, I didn't know what a loan originator was. Like, I mean, if I turned around teams. I was thrust earlier in my career into a leadership position at 26, leading teams of 200 people, tons of hiring, tons of stuff I had no way was ready for. So I learned that stuff, but I never learned what loan origination meant. I never knew what a fix and flip really was. I didn't know we were talking about the Burr strategy before we hit record here a moment ago, right? Like, I didn't get that stuff yet. I saw brokerage growing up. My dad knew that stuff. So I learned that side a bit, but it didn't really show me the broad, awesome world of real estate that is far beyond just transactional residential brokerage.
I know, dude. I'm telling you, there are so many real estate agents. If you're a real estate agent listening to this, please tune in. You are 3 feet from gold. Like every day, like I was very fortunate to join a brokerage that had a broker that was heavily invested in real estate. Had that not happened, I don't know if I would have made the connection of like, I can be the investor. I can own a piece of the thing that I'm helping other people build wealth through. And a lot of real estate agents, they miss it. There was a story locally in our region. I'll kind of say regionally, and I won't mention any names, but there was an agent, longtime agent, did very well, had a successful career, 20, 30 years in the industry, made good money while they were selling real estate. But then when they retired, to your point, there was nothing there. You're 1099. So unless you're intentional to put money away in some kind of an investment vehicle or retirement vehicle,
the
you
faucet,
don't have anything.
Faucet was just shut off at that point.
Shut off. Right. And they had a foreclosure on their personal home, which is just, it's a sad irony. But I take that as a lesson of like, especially younger people now. There was a time where you could work a job, maybe at a corporate level or a factory level, and there was a retirement structure in place that you could just lean on and trust. Gone are the days that is a reality. So people have to be thinking about these things now. It's too late when you get 50 years old. You can't make moves like that. So kudos to you that you kind of like saw, hey, I'm making good money, but I need to do something that is going to help me transition at some point.
Absolutely right. And man, you just nailed it on the gap of knowledge for people who are in transactional careers. And this is a real quick aside, but I think it's so potent. This is like a driving force for me as to why this journey started. My dad had that real estate business. I was working in it young. And I unfortunately witnessed like our family go through this dark decade. And I won't go too grim here, but this is just what happened. Like we lost like a lot of family in a quick string, including like my younger brother when he was a teenager. That was 20 years ago. So it's a lot of time has passed, but that accumulated with just a lot of other loss. A couple of grandparents shortly after that. My dad's business shrunk. That was the single income in our family at the time, and we were living very well, right? Like we weren't like there's no poverty here. It was a very comfortable lifestyle until it wasn't.
Right.
And that was my firsthand observation of what happens when you rely on a single transactional income.
All your eggs
there's
in
no
that
financial
basket,
moat,
man.
Yeah, and so watching what happens to your point earlier of like when other agents and brokers actually do go out and they say, I'm going to take that income, that big proverbial bucket. If this was a Robert Kiyosaki purple book example, he'd say the big proverbial cash bucket, dump it on the table. Are you going to use that to convert that into a pipeline or some form of cash flow from an investment? That didn't click at that time for my family. So when I got to be older, running my own family along with Jennifer, 2 young boys, Bay Area, I'm sitting there going, that seed had been planted. I just didn't unlock it until I got into the guts of working inside my 5th tech company, which happened to also just be a real estate lender.
Yeah.
And I'm seeing the transactions from the inside. And I'm seeing like, wow, oh my God, like that person and that company are making that amount on that flip. And that's really remarkable. But I can't flip, man. I can't swing a hammer. Like I know business very well, hiring people, leadership, all that stuff. But I saw the number of zeros. I saw the success these folks were having. Some of them scaled amazing flip businesses. Some of them first time HGTV home watching folks that said, I want to go flip. And I've never flipped before.
Right.
And I'm like, there's a version of this that I want to lean into. And
how did you translate that to success for you? I mean, talk about taking action. You saw that, you had a choice, and you could have just hit that bear and be like, well, I can't be the one swinging the hammer. Therefore, there's no place for me in this. But obviously, we know that you've put some success together, or else we wouldn't be here.
Yeah. So what was your first touch point, you personally investing into real estate?
I think there, in hindsight, it's 3 phases, right? But again, clear as mud. I didn't know these phases we were in when this happened. But we had done well on our W-2 income, so we had some capital, and we wanted to go buy a local rental. Local rentals in the Bay Area, in our case, was a $430,000 duplex that cash flowed $200 a month.
Wow, those are thin margins for a lot of debt.
Oh yeah,
back in 2016 or 2017.
This is around 2016. Yeah.
Wow. So that was So now it probably wouldn't cash flow at all.
Appreciation's been killer, right?
Yeah.
Oh my gosh, yeah.
That wasn't the point for that $100,000 down payment.
Right.
But I just didn't get it. I didn't understand cash flow goal setting. And so, and we drove around the whole damn summer to go find that thing. I mean, with the baby in the car. Yeah.
Wow.
And so we still have it now. Happy for that. But
nice.
We went to phase 2. We're like, dollar has to stretch further. We went and looked in long distance rentals, right? And along the way, side note, I read 24 books in an 18-month period, which is a lot for me.
Yeah.
Listened to over 400 podcasts, and eventually that stuff became procrastination, as everyone knows, right? It's like, could have read 3 books.
It's a starting point. Like, learning is always a starting point, but you can't stay there, right? So at some point you got to move off that. So, the advice for someone who hasn't done anything is learn. And then the next piece of advice is move off of that into doing it. And I feel like a lot of people are like, oh man, and they just get comfortable in that learning. So, so you did a lot of consumption. Did you successfully, pursue that long distance rental investing?
We got up to a modest portfolio. We got up to 5 single family rentals. And then we realized shortly after that, as a lot of folks with much more impressive portfolios I've come to meet over the years of doing this now, 5 was big for us, but it ain't those 80 to 100 door folks on the single families that have been doing it the right way for decades. One mortgage and one closing at a time. But we realized, like, a couple of years in, we're like, we're getting notices from the county. We're also turning over tenants in a C-class neighborhood relatively frequently on an annual basis. The economics were killer, like mind-blowingly killer. Like, for us coming from the Bay Area, 5 properties, let's say average of $60K per purchase price, right? And
wow,
that translating to like $250 a month in cash flow. That's outstanding, but it's still semi-passive at best.
Right.
And that was the big learning, at least for us at that phase. And so, you
hit the next issue is, how do I scale?
Yeah, exactly.
Where were you buying these? What markets were you looking at?
Midwest, like Kansas City.
Okay. Yeah.
Yeah. And we were generally happy with the performance, but I'd say the overhead was more than we bargained for, and we're still looking full time at that point.
Right. So you rinsed and repeated that for a while, figured out it probably wasn't sustainable or not really what you wanted to spend your time on to grow. So what'd you do? How'd you transition out of that?
It started looking at other alternative strategies, and once I started looking at the pro formas and underwriting deals for bigger apartments, right? We were looking originally at duplexes, singles. And over time, I'd read a few books that was like, well, go look for more predictability, and predictability in my mind, as a guy who'd been in operations and scaling teams for financial tech companies. I knew spreadsheets, I knew people, I understood systems and scale. So multifamily was very attractive to me at first. And we started looking at those. And, long story short, I was networking like a madman, and I was trying to find how do we just go dip our toe in the water. So we ended up investing, $25K in our first multifamily syndication with the team. Went very well. Clearly, everyone who's active and probably hearing this along with you guys is like, timing does. Yeah, I believe in the
right.
platitude of time in the market.
What year was that?
That was around like 2017 or something.
Okay,
Like,
cool.
And we were doing this in parallel, realizing quickly about the rentals. Like all of that happened much faster, I think, for us than some folks who put the work in over a long period of time and build bigger portfolios. But we just got there because I didn't like the rental model at that time didn't fit us great. And so 25K in, and then some more after that shortly after, and it became very clear very quickly. And I think of this kind of as our third phase that we are still in now, is like coworkers start asking you,
yeah,
well, that went so well. What are you putting your money in?
Right.
And
you start turning heads. So let me ask you a question. This is kind of a transparent question. So, I guess deflect it if you don't want to answer it. But during the time period that you invested, right, a lot of operators said, hey, here's a 5-year window that we're going to execute this business plan.
Yeah.
Because of kind of those tailwinds, they were able to exceed the time frame and compress that maybe to like take a property full cycle in a year and a half, or 2 years, right? So you're cycling your capital a lot faster. What was the initial investment amount that you put into those deals? And then what did you do when those went full cycle? Did you pull some out? Did you double down and put them back in? Is that how kind of your nest egg grew to the point that you eclipsed you put 7 figures worth of capital into these deals?
It, like everything else in investing, I try to come back to the word and, right, instead of or. I think one of the things that is dangerous in investing in entrepreneurship is being too myopic. It's helpful when you're getting something off the ground and just burn the boats, as it were, ethos, only focusing on one thing. When it comes to investing, looking across and saying, how do we pull the best parts of these different capital sources? Capital source one, strong W-2 income from 2 people who have been working for 13 years, right? Capital source two, yeah, I mean, we got lucky. We bought a Bay Area house in 2013 in a hot market. And rates were outstanding for like a decade. So that helped. I mean, HELOC, I think we had 3 refinances in HELOC.
Come on.
Wow.
And then to your point, exactly right. Which is we had some exits, and some of those compounded. We took those proceeds, the whole double your money in a 2.5-2 year period. Take those proceeds, reinvest them. In some cases, we were able to move with a 1031 with the right sponsors and deals. And that was very helpful.
Wow, that's wild. I mean, that's what's cool though is you said the word lucky and double your money in 2.5 years, right? Somebody could just chalk that up and be like, "Hey, Spencer, you just got into the market at the right time." And at the end of the day, there were a bunch of people that had the money and knew about real estate in 2017 and didn't get in the market. And so it wasn't. Don't listen to this and be like, oh, it's lucky. It's like, no, time in the market. And when you're in the market, you will experience those kind of hyperbolic moments like we did in 2017 through 2019, that pre-spot. So I really want to get into using that experience, right? Having gotten in the game, pivoted, you landed on passive investing that fit well for your family, your goals. What are some top lessons that you learned from being on the passive investor side of the equation?
Gosh, the first one being the most simple sounding and the hardest in practice, which is asking myself, what's the goal for the money? And being truly honest with myself. And I have to come back to this. Every time I see a beautiful looking PDF investment summary for a new deal or opportunity to invest in, our lizard brain kicks on. Someone sees a 30% projected IRR and we're like, I thought our goal was cash flow. And it's a development deal instead.
Right.
I challenge anyone out there to say that it's easy to overcome that. It's not, right? I don't care what your IQ level is. There's people way smarter than me that succumb to this all the time. And we have great conversations about this, hey, Spence, I just found this really amazing deal. Can you take a look and give me feedback? And I'm like, that is a great looking deal. It's completely the opposite of the goals you're trying to achieve.
Yeah. Right. And break that down. Why would that matter to somebody? Because somebody might say, hey, it's an IRR's return nonetheless. So why would that be maybe not for somebody who's looking for cash flow?
Yeah. This is one of these corporate things that I love, and it's timeless, which is time-bound goals. Time-bound goals. And one of the most important exercises, brief story, when Jennifer and I first decided to walk this crazy path, we were still working full time, didn't go through those 3 phases yet. We sat down, cleared the calendar for a whole weekend, hired a sitter, and nerded out incredibly hard and had some really pretty hardcore couple debate. We're talking a weekend of hashing out what is the passive dollar amount we want coming in cash on a monthly basis by X year?
Yeah.
Yeah.
Right.
And that people are like, I don't want to do that. I just want to invest. To be like, you're welcome to do that. We did all that. We still messed up the first investment.
Yeah.
But it was so vital because we said within the original time horizon, we walked out of that weekend with was in 15 years, we want to hit this dollar amount of passive income per month. And then we came back the next week and we're like, that's way too long. Let's cut it down to 7. And then we ended up hitting it in 5.
Oh,
right?
wow.
That's wild.
But
wild.
I mean, I bring that up just because like in practice, when you're looking at these different deals and a person says, well, do I want the cash flow? Well, I can't answer that question for them.
Yeah.
It's about where they're at. Like if you are an Apple software engineer making $400,000 a year and you have no intentions of leaving because you generally like your career, you have 2 kids, they're at a, tween age, and you want to actually pivot out of that career within an 8 to 10 year time horizon, you got some time.
Yeah.
Maybe that IRR makes sense because you are an equity investor and you don't need the cash flow. If you're a few years into that plan, probably want to start pivoting, probably want to think about more cash flow because you're going to want to rely on it when you want to go build your stealth startup. That was a made up example. Although we do have a lot of people that fit that profile in our investing club. You could also be on the other side, a 3rd generation construction company owner who's about to retire and pass the reins down to your kids. And you're just looking to diversify because almost all of your wealth is currently held in your company alone.
Right.
And that's different.
I love that. The burden, the first lesson that you're talking about has nothing to do with the operator or the property that you're looking at investing in. It's right. The burden is on you as the investor to know, what am I looking to get out of it? And you got to have a personal plan. That's no one else's responsibility but your own. And then you won't be subject to, because there's all types of deal structures, and people, they kind of look at a 30,000 foot view and they're like, oh, IRR. They look at maybe 1 or 2 metrics, and there's much more going on beneath the surface. Yeah. What's another lesson that you learned kind of from being active and in the game?
I think generally folks out there will know the framework of you have to look at the operator, the market, and the deal, right? The team, the market, and the deal. Maybe for the active folks, this sounds like it's contrived or played out. They've heard it before, but it has to be stated at near the top of the list, which is if you assign a weighting, how much importance do you place on the team, the market, or the deal? The team takes like 90+%. If I were to try to assign a number to that, right? A great operator can make an okay deal do well. Vice versa, not so much. An underperforming, inexperienced, process lacking operator can find an outstanding cost basis at acquisition and completely fumble it.
Yep.
So it really just depends on the team that you're going into. But I would just want to emphasize one thing here is key lesson in learning from, I think, before and after COVID and Jerome Powell's past 2 years, which is track record vetting. Track record vetting meant something really for me, meant something that was like, look at their exits, look at how they did. There's more to it. There's like a 70-row spreadsheet behind each of these buckets, right? But for the sake of discussion here, when we're vetting a track record, it's not just how good were the exits, because to your point earlier, they can catch a good tailwind, right? Yep. They can catch a good moment, and many did.
Market forces made a lot of people look really good that were not good operators. And so that Absolutely. If you're basing it on that, and unfortunately, people are looking at those things, right? If I had a great exit as an operator, 2.5, 3x, equity multiple, I'm going to shout that from the rooftops. Why wouldn't I want to use that success to roll it forward? And if investors are just looking at that, what they're actually looking at is what the market did, not my expertise or my execution on a business plan. And unfortunately, a lot of investors are now finding out, as the tide has gone out, whose drawers are down on their ankles and who, you're starting to see it for what it is. So that's a great lesson. I want to comment on the team thing. You said 90% of the weight of those 3 categories is on the team. Breaking that down a little bit further, part of the reason the burden or the bulk, the lion's share of that importance is on the team is a good team is going to know how to identify good deals, identify good markets. So just by picking the right team, you're trusting their expertise to look at the macro level all the way down to the micro level of a property and evaluate and filter those deals instead of just jumping into a deal and then saying, well, we're sophisticated, right? You're buying the deals that they don't buy, right? So that they've selected the good ones. So I think there's an important kind of distinction there.
And maybe here's a question too. Would you do a deal with a new operator?
That's a good
So
question.
An operator that doesn't have a track record, maybe they've bought a couple properties, maybe they haven't exited, or maybe it's their first property and they've done other stuff in real estate. Would you ever invest with a new operator?
I'm hesitating and letting out that really big sigh there because I think that we have, and here's the irony. Some of the best exits that we had in the past 7 to 8 years have been from people that were relatively new.
Mm-hmm.
Now, back to the prior bullet point we were talking about, that still required some execution and it went well. But there was also some really healthy tailwinds. So now there's a few things that I would say just declaratively and very plainly, which is no. The answer is not no, but it's really not yet. Right.
Mm-hmm.
So I would not invest with someone who's brand new, personally, passively. But I would also say that if I put on the lender hat for a minute, and I didn't learn this like from, just waking up one day, I went in the guts of this lender and learned from people who have been in mortgage and industry and real estate for decades, right? They lived through and worked through 2008.
Yeah.
And I learned this idea of when you try to get a loan, like, what is the bank going to say? They're going to say, let's look at this picture of this person borrowing in their business. They're also going to say, if you don't have a track record, or if you don't have something that looks good, great credit score, they're going to say, we want to see compensating factors, right? That phrase is a helpful construct. And I won't go much nerdier here. I don't want to scare people away talking about lender stuff, but but same idea when vetting a team, right? Like,
Yeah.
I think being dogmatic and rigid means you will never find a deal sometimes, ever. So you have to think about compromise and also, but not, you're not going to go and give up your integrity. You're not going to give up really firm boundaries on what you consider a good deal. But if a team is new, bottom line is like, if they haven't done it before, then it's a risk I'm not willing to accept at this point.
Mm-hmm.
I also think that the approach is one, like we have a 5-part vetting framework that I look at. We started this back when we were passive investors just starting out, and we've built on it since then. Look at the team, the approach, the communications, the legal side, and the values of the team. And there's a bunch of nerdy spreadsheet rows beneath each of those with questions that we vet with. And the approach is a big piece of that track record, meaning like if someone can do something and they've done it before, they can explain in boring but exhaustive and important detail how to go do it again. And like, I'm a big guitar nerd. If I'm learning how to play a guitar solo, which I'm not a savant at, I have to work really hard to do that stuff. I can tell you step by step, inch by inch, what I practiced and how to get to that point over a grueling amount of effort. Same thing goes on a real estate deal. Is like if a person knows the business plan because they've done it before, they can tell you what that plan is and they can show you how they did it. And so a brand new sponsor cannot typically do that because they haven't done it.
Yep.
That's well said, man. That's well said. Give us one more lesson that you've learned from being a passive investor in these deals.
Yeah. These are long hold periods. Like passive deals, 5-year pro forma. This is a comment on snapshot. Like, what does it mean to take a snapshot? A snapshot of like the team, the market, and the deal, all that we have at any of our disposal. Like Seth and Garrett, like when you guys like look at deals, we're snapshotting what is the macro context happening? How is the labor market? What's the banking environment? How are lenders acting? We're snapshotting geopolitical stuff we can't control. We're also looking, like if we passively look as an investor at the sponsor, that's a human being. And a human being, snapshot in time, unfortunately, happy to share, like of all the 7 figures in capital we've invested, not all of them have gone perfectly, right? And there has been, unfortunately, in 1 or 2 cases, bad behavior. And did we diligence that person, that team? Absolutely. Did they pass criminal civil background check? Of course, it was sparkling clean. Did that people in pressure and humans do weird stuff over the 5 to 7 year period?
That's good.
Their lives change, man. Their lives change. Wild stuff happens, And so I won't preach much more people, but I'll just say these are snapshots in time. You can diligence those numbers all you want. You're investing in some humans.
Yeah, no,
that's a good thing to remember.
I've talked to a number of investors who have participated in deals from a passive perspective, and this is actually very encouraging to me. Somebody who is on the active side of things, sourcing, finding, structuring, being the sponsor, where people are investing in. So this passive investor said, one of the things we look for is how do people handle things when they don't go right? Like,
yes.
watching the behaviors, the attitudes, the action or inaction that they take when something doesn't go right. And so sometimes as an operator, you're feeling all this pressure. It's got to go perfect. It's got to go perfect. And I think it's a good pressure to feel, to strive for that. But there are so many variables in real estate, and it's not a matter of if things will go wrong, it's when things go wrong. And how does your team respond in those high pressure situations? Does your integrity compromise? Do you, get sloppy on your execution or your business plan? Did you have a strong business plan to start with, and now it's being exposed that there were poorly thought out, aspects of that? And so don't be afraid of the fire as an operator, because how you handle those situations is actually, people are watching, is I guess kind of the nuts and bolts of it. Would you comment on anything with that?
Absolutely. Yeah. And the fire coming and the challenges coming is the reality. I think that so many folks, myself included, and I really appreciate you going there, is like, people expect, like when I go and I invest in an ETF, like there's a lot happening behind the scenes at every company this thing is invested in across the market index. Do I know the day-to-day happenings of who is sitting in what meeting at this company out of the thousands in there? No. That's the difference, I would say, is that when I'm signing up to invest $100,000 into a passive private market real estate deal managed by a great looking team, I'm going to know more about this than I've ever known about a very distant, intellectually, no human beings involved stock.
That's true.
Be ready for that.
Yeah.
Just be ready for that, because you can always tell. Here's a nerdy example. Early first-time passive investors do exactly what I did when I first went as an LP. They're like, show me the pro forma, but also that first quarterly distribution. I want to see that financial report, and I want to see it. And good on them for asking, because that's what I do too. But watch the data when we send out the 6th month, the 24th month financial reports. How much more closely are people looking at that point once they get comfortable with the fact that the team is doing well? Less than 3%, if that, of people who are getting that report actually click and open, let alone read it. So just, again, just trying to make it more tangible for folks as someone who's gone through this so many times now. Stuff does happen. And what matters most is, to exactly your point, how do people show up, and do they communicate bad news quickly? Because the bad news is going to come. If it's small bad news, great. If it's manageable bad news, great. Because that's just a good operator.
Would you say that you prefer too much information or maybe like discretion, and you don't want someone to blow up your email in terms of communication from a sponsor to you as an investor? Yeah,
gosh, that's a great question. I think material information, which is the most safe way to say that. I think probably number one, financial transparency delivered cleanly in a polished way. Just if you ask for the numbers, can they be provided readily? Because then when it all comes down to it, fluffy language on an email is great. It makes me feel good too. And I do think right. But in the end, you need to have the numbers available, and they should be readily available to provide. And I think that's number one. Number two would be taking on the business hat again, real estate or not real estate. A mentor of mine once said, like, Spence, it's okay to give bad news, but you better not give bad news without a plan.
Yeah, right. That's good.
I mean, that's universal, right?
You're like, well, the bad news is we had a fire. And everybody's like, okay. And you're like, it's terrible.
We don't have any money. Yeah, we don't have any money in the account, and I actually didn't have insurance. So,
does anybody have any suggestions on what to do?
Yeah.
Oh man. Real quick before we go to our smaller pockets, I really do want to kind of get inside your brain. You're seeing a lot of deals, I'm sure, coming across your desk. You're having a lot of these conversations with other investors, monitoring, keeping a close pulse on what's happening right now in the market, and how that's going to affect deal flow, opportunity, investment. So what's your investing thesis here for the tail end of 2024, moving into 2025?
Yeah, and I'll give my, of course, obligatory, I don't own a crystal ball disclaimer. I still don't. Still waiting for that in the mail.
Classic.
Everyone, I'll speak for myself. I was surprised to see the Fed cut by 50 basis points last week. I think that was bigger than many were expecting. For myself, transactions have been slow. The banking environment's been tight. I think that in the next 12 months, back half of 2025, we're going to start seeing stuff in the commercial space get much more active, would be my theory. Where I am focusing right now is really two areas. And the first area that I have been excited about and we have been leaning into and investing in is still, I like private credit. I still think that the right type of private credit or private debt will continue to make sense, even though, I think people are getting it twisted. They think a 50 bip cut from Jerome Powell is going to suddenly make it so that banks are going to lend immediately. Mortgages for commercial are tied to the 10-year treasury, not the Fed funds rate. So we're looking at some, higher rates are still sticking around for a while. And so private credit being, investing more on that side of the balance sheet, investing into that and being the bank is still interesting because there's great deals to be bought. And now we're going to be looking at maybe 12, 18 months of great deals to be purchased that still need preferred equity. They still need mezzanine. They still need a little bit of a gap fill. And that's where private credit's exciting to me. And that applies to multifamily. That applies to industrial. That applies to a bunch of other stuff.
Man, I agree. I think right now from an operational perspective, I'm excited because there's this kind of like lag period where the interest rates haven't reflected, right? So if you can find a deal now that pencils, that makes sense in today's environment, year 2, year 3 of that business plan, I think you're going to see some really nice kind of tailwinds pushing things up. And if you wait 24 months,
you're going to miss it.
You're going to miss it because a lot of that money's going to come off the sidelines. I think there'll still be opportunity, but I don't know. I've been really cognizant of like, man, can we make something work in today's environment? If so, it's a good deal. It's actually probably a better deal than what it looks on paper today. And I just tell people, I was like, we don't have a crystal ball. So at the end of the day, if rates don't come down like we think, it's okay because it penciled in today's deals. You don't want to be in a spot where you're speculating and that's your strategy is we need rates to come down and then it works. That's just hope is not a strategy. So,
all right, we're going to jump into our smaller pocket segment here.
Let's do it.
So what is one of the worst real estate or business deals that you've been a part of, Spencer? It could be something from, pre-LP status when you were doing more of the single family stuff and the hands-on portion, and actually I would preferentially, if you have an operational, property that you were invested in that didn't go well, because that's what the topic of our conversation's been, maybe share a story from that.
Yeah. 2 quick ones. I'd say one of which of those single family rentals that we bought when we were still buying single family rentals in the Midwest, there was one in particular. But, and I think a lot of folks that have done single family can relate to this. Like we were getting notices about furniture on the lawn regularly. We were getting
that's never good.
I mean, like sizable repair bills, and like we're sitting there with a property manager we're paying 10% of the revenue every month for. But they're not absorbing any of that overhead. So we still had to deal with that stuff. You don't want to have to deal with those rentals where you're like, why did I buy this property? So that was the first one. If I were to pick the second one, I mean, maybe this is like a sampling of a few, but we put so much in to so many deals. Your cash flow goals have to get tweaked when like you get more than one pause distribution. And pause distributions are just the reality for those of us that have been participating in the years leading up to, but also in 2021, 2022 in particular. Thankfully, I haven't lost a single dollar of capital yet, but I would just say that hopefully it stays yet. And those types of moments when you're like, man, I wish I had just reallocated differently, and also thought an interest rate cap is helpful, vitally helpful, but it's not necessarily going to help me stay on track back to that really important question that we got to earlier of like, what's the goal for the money? If the goal for the money is cash flow, be mindful of what debt can do to it.
Have you so up to this point in all the passive deals that you've been in, has any of those deals gone sideways and lost money, or have you at least been able to retain your capital and get out if it was going bad? Or
zero capital loss on real estate deals to date.
Wow.
I mean, have lost capital on non-real estate alternative stuff, crypto stuff, which is totally different, but
right here, buddy.
I deserve that one
right here.
Yeah.
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 If you want, like, I've got a support group I'm in if you want to join that and be a part of it.
I think we're all guilty. I think we're all guilty a little bit. So.
Oh, what a wild ride it was, though. Let me tell you. Oh, that was fun until it wasn't. So anyway, that's why I invest in hard assets. Okay, we're going to go into what we call our little nugget. So Spencer, this is a part of our show where you give us a practical takeaway. You've given us a lot already, but we're going to ask for something a little bit different. Something that somebody could apply to their real estate investing business or even their personal growth.
This is a baseline fundamental thing, and I have to remind myself of this often, and I probably forever will. It's just that important. And that's, if I could go back in time and tell my younger self, like, what's one thing to change, it would be treat every person you meet, every colleague, anyone at school or otherwise, treat them as a long-term relationship and not a transaction. Because it's amazing what comes back around. It's amazing how relationships unlock potential. And a book recommendation I'll give, in case people haven't picked it up yet, I've read it 3 times already, and I'll probably come back to it again, is Essentialism by Greg McKeown. It gives you, I think, 5 ways to say no, grace with your social graces intact.
Yeah, that was what I was literally just going to ask you. Is like, sometimes you have to have hard conversations.
Focus is important, and so that's why it may seem contradictory when I say focus on relationships, but also go read this book that tells you how to say no to people. But that's exactly the point. Is like, be mindful of your time and realize that you got to go set those goals. You got to go focus on moving forward. But the relationships you build are going to be lifelong if you do it right. And also, but you're going to have to say no and say, hey, when that friend comes and says, hey, can we get a coffee, or can we go to happy hour after work, or can you want to play some Xbox, for the nerds out there with my nerd brethren. But like, you got to figure out how do you do both, and how do you build relationships, but also get done what's got to get done along the way. And that book really helped me. And
I was really, and I still struggle with this. I was really afraid to tell people no because I didn't want people to experience rejection. I always just want to lean into a relationship, but you spread yourself so thin and you end up wondering why you're not moving towards your goal. And what I've realized is a lot of it is setting the right expectations on the front end.
Yes. And
people really respect a person of conviction and focus. And what's weird, so my wife and I, we have 6 kids, and our margin is relatively thin. People look at my life situation and they don't expect me to have a lot to offer to them. They just don't, because they see my commitments that I've made to my family and in my work. And because I've communicated that from who I am, they don't have unrealistic expectations of me most of the time when it comes to that. And so that's more of a subconscious thing that's being communicated, but even sometimes you have to set the expectation.
That's one of the perks of having a lot of kids, though. It's an easy letdown. Hey, can you come do this? I got 6 kids. They're like, whoa, man. Hey, I get it.
Hey,
you got to get home. You got to get home. You go, man. You go.
Oh, shoot. So, but like setting that expectation is really big in early on, because then nobody feels like snubbed or anything. It's like, hey, I said this from the beginning, and anyway, that's really good. Learning how to say no in a graceful way.
So that was called Essentialism is the book?
Essentialism by Greg McKeown. Yeah.
Okay.
Very cool. Very cool. So what's been one of the best resources in your business development?
Oh my goodness. I mean, we've already mentioned some of the stuff that's readily available, including this podcast and other podcasts, books.
Hey, we didn't ask Spencer to say that, by the way. So
yeah, no, this is not a paid promotion. But I will say that I've used 4 different coaching programs.
Okay.
I do think that you have to do extensive diligence and make sure it's right fit for the specific thing that you want to do. Before you drop 4 or 5 digits into a coaching program. I've never done a 6-digit one. I know they're out there, and some of them are good. Those are key though. Like, they've been so helpful. And so I just want to mention that for folks. I approached it like, each specific skill, I would sign up for a specific program after vetting it and looking across the landscape. I wanted to go deep on commercial underwriting. I knew residential. Going to go through a program like that years ago.
Did you ever do a paid coaching program and regret it afterwards, or feel like, that was a waste of money? Because I think that's always the fear. Yeah. As people are getting in this real estate space, there's a lot of different programs out there. To your point, you got to vet them.
People that'll take your money.
But there's a lot of people who will be like, hey, here's my course. Here's my, this is a few $100. This is a few $1,000. This is $10,000.
Yeah.
Have you ever done something and was like, gosh, I got taken for a ride on this? Or has generally, if you vet well, do you feel like it's a good value and a good way to spend your money and time?
I have experienced that not because the program wasn't good, but because I was doing it. I signed on with the wrong person for where they're at in their journey compared to where I'm at in my journey. And I mean, great example of, okay, if I had 6 kids, I only have 2 and I feel like I'm already working my butt off. So good on you, man. That is amazing. It's a beautiful family. So all that said, did it make sense for me to go drop a 5-digit sizable number on a coaching program for someone who has no kids right out the gates? I say that's a no. And maybe that's controversial. Maybe people are gonna be like, what is he talking about? I'm sorry. You can't relate.
Because the lifestyle, it's more of a lifestyle alignment at that point. Their exactly paradigm of how they're looking at investing in business is just going to be vastly different. We were actually talking about this today with a different podcast we were listening to. Yeah. And it was like, you knew this person didn't have a family, and they were talking to single people. They were not talking to people that had a wife, and it just doesn't relate. It doesn't translate. And
there's no judgments in any of this, of course. Yeah. It's all about, I mean, frankly, it's a time management comment.
Yeah.
More than anything. It's like, don't assume I have 4 hours in an evening to go and dive into this. I mean, I'm barely scraping out early morning and scraping out the weekend. So to do anything that's project oriented and the deep thinking stuff, right? So just that type of stuff. Like, don't assume I have that time. I know 6 kids, you don't. So it's, it's that type of alignment. It's about alignment of purpose before you allocate those dollars. But frankly, I haven't encountered a bad coaching program, and I'm grateful for that so far.
Good.
That's awesome.
Awesome.
Hey, how can people find out more about you, connect with you, follow your success?
Yeah, they can check us out at MadisonInvesting.com. They can set up a call with me just to share notes and nerd out on real estate and investing.
And I don't think we dug into the beginning on even what that exactly was. I know we said it was your investment company, but can you explain what that is and why someone should even look it up?
Yeah, no, very simple. We're a passive investing club. Started organically because we were investing our own money as LPs. So what we do now is a more advanced version of what started like 8 years ago. We find great teams, sponsors, then we build a relationship, we put our own money in with them. And if it vets, and we like that team, we look at their deals on a case-by-case basis. And if we find a good deal, we share that with our group. So it's primarily multifamily, self-storage, and then occasionally some alternative investment stuff. Right now,
what I like about this is it's kind of a think tank for people who are wanting to get in with like-minded investors, peer-to-peer, and make sense of what they're seeing on an OM and asking the right questions, right? And lean on the experience that you have from being in these deals. So look that up, please. We'll put those links in the show notes as always. And Spencer, thank you so much for jumping on today's episode, man.
Yeah, thank you to you guys. This has been an awesome way to spend the time.
Likewise. Awesome, man. Blessings. As always, excited that you joined us for another episode of the Reinvest Podcast. Stay tuned every Tuesday for new episodes. And if you want to learn how you can use your hard-earned capital to diversify into real estate, go to our website, lv5capital.com, and shoot us a message. Move farther, reach higher, and grow deeper. We'll see you next time.